Stop what you're doing. This is not a drill. 2 hours ago, the Chinese Ministry of Commerce issued an emergency decree banning all silver exports effective immediately. No warning, no phase-in period, no exceptions. Within 120 minutes of that announcement, silver exploded $40 per ounce. From $48 to $88. A move that normally takes months, happened in 2 hours. If you're watching this within the first few hours of upload, markets are still reacting, prices are still moving. And what I'm about to show you explains exactly why this happened, what it means for the next 24 to 72 hours, and how you need to be thinking about this, whether you're a long-term stacker or a short-term trader. This is the most significant development in the silver market since the Hunt brothers squeeze of 1980. And I'm not saying that for clicks. The math proves it. Let me show you exactly what just happened. John Jade here. Before we dive into the data, standard disclaimer that's more important than ever right now. In times of market chaos, scammers multiply. They will use my name. They will use my content. They will claim to have signals, private groups, or insider information. I don't sell signals. I don't sell mentorship. I don't have paid groups. I'm only on YouTube and X. My handle on both platforms is JohnJD_silver. That's the only way you know it's really me. If anyone contacts you claiming to be me with trading advice or investment opportunities, block them immediately. Report them. In volatile markets like today, these scammers prey on fear and greed. Don't become a victim while trying to navigate a real crisis. Now, everything I'm about to share comes from official Chinese state media translations, COMEX data feeds, Shanghai Futures Exchange filings, and real-time dealer communications. I'll show you sources throughout. Verify everything independently. Let's break down what just happened. Quick note, about 74% of you watching right now aren't subscribed. In fast-moving situations like this, I'll be posting updates as new information comes in. Subscribing with notifications on is the only way to ensure you see those updates in real time. Drop China ban in the comments if you want continuous coverage of this developing story. Let me know where you are in the world and what you're seeing locally. Dealer behavior, premium changes, availability. Your on-the-ground reports help this entire community understand what's really happening. Now let's get into the details. Here's the exact sequence of events as we currently understand them. Timeline breakdown, 6 o'clock Beijing time, 18 o'clock EST, previous day. Chinese Ministry of Commerce publishes emergency notice on official government website. Document number, UMOFCOM 2000-250847. Title translates to, Emergency Measures Regarding Strategic Metal Export Controls. 6:15 Beijing time. State media outlet, Xinhua, publishes summary, key phrase translated. All exports of silver in refined, semi-refined, and ore form are suspended indefinitely, effective immediately. Existing export contracts are void. Violations subject to criminal prosecution. 6:32 Beijing time. Shanghai Futures Exchange halts silver trading for price limit review. Trading was locked limit up within 8 minutes of reopening. 6:45 Beijing time. Hong Kong dealers begin reporting they cannot source mainland silver. Premiums immediately spike to $25 over spot. 7 o'clock Beijing time. News reaches Western markets. COMEX electronic trading begins showing extreme volatility. 7:15 Beijing time, 19:15 EST. Silver breaks $60 for the first time since 1980 on COMEX futures. 7:45 Beijing time, 19:45 EST. Silver breaks $70. Circuit breakers trigger 5-minute trading halt. 8:15 Beijing time, 20:15 EST. Silver reaches $88.47 before pulling back slightly. Total move $40.12 in just over 2 hours. Let me put these numbers in context. A $40 move represents an 83% increase from the $48 starting price in 2 hours. For comparison, the entire 2020 to 2021 silver rally from $12 to $30 took 11 months. Today's move covered more percentage ground in 120 minutes than that entire bull run. This is not normal price discovery. This is structural break. Why China matters mathematically. China is the world's largest silver consumer, accounting for approximately 28% of global industrial demand. But more importantly, China produces approximately 3,400 metric tons of refined silver annually, representing roughly 13% of global mine supply. Here's where the math gets critical. China doesn't export raw production. They import silver for industrial use, process it, and export finished goods containing silver. But they also re-export refined silver through Hong Kong and direct channels. Estimates suggest 800 to 1,200 metric tons of refined silver flow out of China annually through various channels. That's roughly 25 to 38 million ounces per year. By banning exports, China just removed 25 to 38 million ounces of annual supply from the global market. Immediately, without warning, global annual silver deficit was already 215 million ounces before this announcement. China just increased that deficit by 12 to 18%, and they did it in one sentence. The official justification. The Ministry of Commerce statement cites 3 reasons for the emergency export ban. Reason 1, strategic resource preservation for domestic industrial development. Reason 2, national security considerations regarding critical technology supply chains. Reason 3, price stabilization measures to protect domestic manufacturers from international speculation. Translation: China is hoarding silver for its own solar panel production, EV manufacturing, and electronics industry. They've decided their domestic needs outweigh their interest in supplying Western markets. This has been coming for years. I've discussed China's strategic metal policies multiple times on this channel, but the speed and totality of this ban caught everyone off guard. No phase-in period. No quota system. No exceptions. Complete and immediate prohibition. Let me show you what's happening across global markets right now. COMEX Silver Futures. Current price as of recording, $84.35. Session high, $88.47. Session low before announcement, $48.23. Trading volume, 847% above 30-day average. Open interest. Spiking as new longs enter. The COMEX price is still finding equilibrium. Expect continued volatility throughout the session. Shanghai Futures Exchange. Trading halted after hitting limit up 3 consecutive times. Last traded price, yuan equivalent of $97.40 per ounce. Shanghai Premium to COMEX, $13.05 or 15.4%. Shanghai is pricing silver higher than New York. This makes sense. Chinese silver now cannot leave the country. Domestic supply is captive. Domestic prices reflect that scarcity. Physical dealer status. I've contacted 12 major online dealers in the past 90 minutes. Here's what I found. A Pemex website showing inventory alerts on most silver products. Some items already showing out of stock. JM Bullion. Premiums have jumped $8 to $12 per ounce across all categories since this morning. SD Bullion. Order processing delays announced. Warning of 3 to 5 day verification period for large orders. Silver Gold Bull. Canadian inventory being held pending price stabilization. Local coin shops. Multiple reports of shops closing early to reassess pricing. One dealer in Texas reported selling entire silver inventory within 45 minutes of opening. The physical market is responding exactly as you'd expect in a supply crisis. Sellers are pulling inventory. Buyers are panicking. Premiums are exploding. Mining stocks. First Majestic Silver, up 47% in pre-market trading. Pan American Silver, up 38%. Hecla Mining, up 41%. Endeavor Silver, up 52%. Core Mining, up 44%. The market is pricing immediate and sustained benefit to silver producers from higher prices. Gold correlation. Gold is up 8% in sympathy, currently trading at $3,485 per ounce. The gold-silver ratio has compressed from 72:1 to 41:1 in 2 hours. This is the fastest ratio compression in recorded history. Historically, ratio compression during silver squeezes continues until reaching 31 to 35:1 range. If gold holds $3,485 and the ratio compresses to 32:1, the implied silver price is $108.90. We may not be done moving. I've covered silver market events for years. I've seen short squeezes. I've seen delivery demands. I've seen margin hikes and manipulative crashes. This is different. Let me explain why. Difference 1. This is governmental, not market-based. Previous silver squeezes were market phenomena. Traders taking positions, delivery demands creating pressure, margin requirements forcing liquidations. This is a sovereign government, the second largest economy on Earth, making a strategic decision to remove supply from global markets permanently. You can't margin hike away a government export ban. You can't create paper silver to offset physical supply that's been legally prohibited from leaving a country. This is structural, not tactical. Difference 2, this affects physical, not just paper. When COMEX manipulates prices through paper contracts, physical supply still exists somewhere. Dealers can source metal. Delivery is theoretically possible. With an export ban, physical silver inside China is legally trapped. That supply no longer exists for global markets, period. Roughly 1 billion ounces of refined silver inventory sits inside China. As of 2 hours ago, none of it can leave. That's not a paper game. That's physical reality. Difference 3. This was coordinated with industrial policy. China didn't ban silver exports randomly. They've been building toward this for years. They've stockpiled rare earth minerals and restricted exports. They've accumulated copper reserves. They've cornered cobalt supply chains. They've built strategic petroleum reserves. Silver was always next. China's solar industry alone will require an estimated 150 million ounces annually by 2027. Their EV industry, another 80 million ounces. Their electronics industry, another 200 million ounces. Total domestic silver demand, 430 million ounces by 2027. Their domestic production is only 109 million ounces. They need to import 321 million ounces annually just to meet their own needs. Why would they export a single ounce? This isn't a temporary measure. This is permanent industrial policy. The silver that enters China from this day forward stays in China, forever. Difference 4. There is no counter move. When the Hunt brothers squeezed silver in 1980, the COMEX changed the rules. They banned new long positions. They raised margins. They forced liquidation. What rule change counters a sovereign export ban? Does COMEX have jurisdiction over Chinese customs policy? Can margin hikes force China to reopen exports? Can paper contracts create physical ounces that don't exist outside China's borders? The answer is no. There is no countermove. This supply is gone. Pricing must adjust to a world with permanently reduced available supply. Let me speak to two different groups watching this unfold. To the long-term stackers. Many of you have been accumulating physical silver for years. You've watched manipulation. You've watched price suppression. You've been told you were wrong, crazy, or conspiracy theorists. Today, the math validates your thesis in the most dramatic way possible. If you're holding physical silver, your purchasing power just increased 83% in 2 hours. Not paper gains. Real metal that you actually possess. Your patience is being rewarded. Your conviction is being validated. The question now becomes, do you hold for further appreciation, or do you take some profits? That's a personal decision based on your financial situation and goals. But whatever you decide, you're deciding from a position of strength. To the short-term traders, if you're trading silver derivatives right now, I need you to understand the risk environment. Volatility is extreme, spreads are wide, liquidity is questionable, circuit breakers are triggering repeatedly. Getting in is easy. Getting out at your target price is not guaranteed. If you're already positioned long, congratulations. Consider your exit strategy carefully. If you're considering entering new positions right now, understand that you're chasing a move that's already happened. Yes, there may be more upside, but there will also be pullbacks, consolidation, and violent shakeouts. The stackers can wait through volatility because they hold metal. Traders holding leveraged paper can be liquidated by a 15% pullback, even if the long-term move is 200% higher. Know which game you're playing. Size your positions accordingly. In the interest of balanced analysis, let me give you the bearish case. Because even in a genuine supply crisis, prices don't move in straight lines. Bearish factor 1. Profit-taking pullback. An 83% move in 2 hours creates massive paper profits for existing longs. Many will take profits. Expect sharp pullbacks of 15% to 25% as gains are realized. This doesn't change the fundamental picture, but it creates short-term pain for anyone who bought the top. Bearish factor 2. Margin hikes coming. COMEX will raise margin requirements. They always do during volatility. Higher margins force smaller traders to liquidate positions they can no longer afford to maintain. Expect margin hikes within 24 to 48 hours. Expect forced liquidations following those hikes. Bearish factor 3. Government response. The U.S. government may respond to China's export ban with policy measures of their own. Strategic reserve releases. Export restrictions on other materials as retaliation. Emergency measures we can't predict. Government intervention adds uncertainty. Uncertainty creates volatility in both directions. Bearish factor 4. Demand destruction. At $85 silver, some industrial users will seek substitutes, reduce usage, or delay projects. Demand destruction at high prices is real and mathematically inevitable. The question is at what price level demand destruction becomes significant. Estimates suggest major destruction begins around $120 to $150. But some marginal destruction is already happening at current prices. Now the bullish case, which I believe is significantly stronger given the structural nature of this supply shock. Bullish factor 1. Supply gap is permanent. This isn't a temporary squeeze that can be unwound. China's export ban removes 25 to 38 million ounces of annual supply permanently. Global deficit was already 215 million ounces, now it's 240 to 253 million ounces. And growing, prices must rise to equilibrium. That equilibrium is significantly higher than current levels. Bullish factor 2. Other nations may follow. China isn't the only silver producer watching this unfold. Mexico, Peru, Chile, and other major producers are observing how the market responds. If China's export ban results in sustained higher prices without significant consequences, other nations have incentive to implement similar restrictions. Resource nationalism is accelerating globally. Silver may be the next commodity to face export restrictions across multiple jurisdictions. Bullish factor 3, monetary demand activates. At $48 silver, the monetary premium was minimal. Silver was primarily an industrial metal with some investment demand. At $85 silver, the narrative shifts. Headlines change. Public attention increases. Monetary demand from investors seeking alternatives to fiat currency accelerates. This creates a feedback loop. Higher prices attract attention. Attention attracts investment. Investment demand adds to industrial demand. Combined demand pushes prices higher. Cycle repeats. Bullish factor 4. The gold-silver ratio. The ratio just compressed from 72:1 to 41:1. Historical squeeze precedents show ratios reaching 31 to 35:1 before finding equilibrium. If gold holds $3,485 and the ratio compresses to 32:1, implied silver price is $108.90. If gold rallies to $3,800 on safe haven demand and ratio compresses to 31, implied silver price is $126.67. The math supports significantly higher prices even without additional catalysts. Here's what I'm watching over the next 24 to 72 hours. Watch point 1. Official U.S. government response. Any statement from Treasury, Commerce Department, or White House regarding China's export ban. Retaliatory measures or emergency policies will move markets. Watch point 2. COMEX margin announcements. Margin hikes are coming. The question is how aggressive. Moderate hikes suggest controlled response. Aggressive hikes suggest panic. Watch point 3. Physical dealer behavior. If dealers remain closed or sold out for more than 48 hours, physical scarcity is genuine and severe. If inventory returns quickly, the worst of the panic may be passing. Watch point 4. Shanghai premium direction. If Shanghai continues trading at premium to COMEX, two-tier pricing is establishing. If premiums compress, some stabilization is occurring. Watch point 5. Mining stock performance. Sustained gains in mining stocks confirm the market believes higher silver prices are permanent. Reversal in mining stocks suggests the market believes this is temporary. I'll be posting updates as each of these factors develops. Make sure you're subscribed with notifications enabled. Where does this leave us? 3 key takeaways, and we're out. Number 1. This is structural, not tactical. China's export ban permanently removes 25 to 38 million ounces of annual supply from global markets. This is governmental policy, not market manipulation that can be unwound. The global silver deficit just increased 12 to 18% in one announcement. Supply cannot meet demand at previous prices. Prices must rise to new equilibrium. This is the most significant structural change in the silver market since industrial demand began dominating consumption. Number 2. Volatility will be extreme. An 83% move in 2 hours is not normal. Expect pullbacks of 15% to 25% as profits are taken and margins are raised. But pullbacks within a structural bull market are buying opportunities, not reasons to panic. The trend is established. The supply deficit is permanent. Short-term volatility doesn't change long-term trajectory. Traders must manage risk carefully. Stackers can use volatility to accumulate at better prices. Number 3. Physical possession matters more than ever. Silver inside China cannot leave. Paper claims on silver that may or may not exist face unprecedented counterparty risk. Physical silver in your possession has no counterparty risk. It cannot be banned from export because it's already where it belongs. In your hands. If you don't hold it, you don't own it. That phrase has never been more relevant than it is today. The unresolved tension is this. China has made a strategic decision that their industrial future matters more than supplying Western markets. Other nations are watching. The global silver market just fundamentally changed, and prices are still discovering what the new equilibrium looks like. That's the situation as of right now. Markets are still moving. Information is still developing. I'll be posting updates as new data comes in. The next 24 to 72 hours will tell us whether this initial move holds, extends, or pulls back. Here's what I need from you. Drop China ban in the comments if you want continued coverage. Let me know what you're seeing in your local market. Dealer behavior, premiums, availability. Your reports help the entire community understand what's really happening on the ground. Share this video with anyone who needs to understand what just happened. The mainstream financial media will take hours to catch up. This community stays ahead because we share information in real time. Remember why you started stacking in the first place. Moments like this are exactly what you prepared for. The thesis is playing out. The math is validating. Stay calm, stay informed, stay positioned. Do your own due diligence. Verify everything independently. Make decisions based on your own financial situation and risk tolerance. Invest with logic, not panic. Stack with conviction, not desperation. John JD out. Updates coming as this story develops. Subscribe with notifications on to stay ahead of the market.